Alright, welcome to the second video for Unit 4. This time we're looking at non-current assets, what to do with those, and depreciation. So non-current assets is going to be a two-part video. This part going to focus solely on depreciation, while the next part will talk about non-current assets and what we do to sell them, or if we need to sell them, trade them in, all those lovely little things. So just a reminder, this is all still part of the broader topic of balance day adjustments. So if we look at the balance day adjustments, we can see our list again: inventory gain and loss, inventory write down, prepaid and accrued expenses. We've done those three already, but today depreciation, non-current assets, selling, and then after that will be the bad debt / allowance for doubtful debt, and the unearned revenue video. So we've got a lot coming up, but as long as you follow in step by step, you will be fine. So we're going to start with what a non-current asset is. I think that's an important aspect to establish. So a non-current asset is, like all assets, something that gives us future economic benefit, is a result of a past transaction, and it was controlled by the business. The difference here is non-current. So that means we're going to get that benefit beyond a year. Compared to stuff like inventory, which is current because we try and sell it within a year, a non-current asset we will use beyond 1 year. So for example, a car. Now, I think car is the most obvious one, and that's the one we're going to use. You can also use equipment, is also a common one, but it's anything that can be used beyond 1 year. So, as we know, when you want to sell an asset, you're not going to get what you pay for it. It's very rare things appreciate in value where they go up. Normally they depreciate or go down, and that is what we're starting with. So what is depreciation? Depreciation is the allocation of cost of a non-current asset over its useful life. So that reduces the value of an asset, and then in turn, because we've used that asset, it reduces the owner's equity. It is therefore an expense. It meets that definition of an expense. Reduces the asset, reduces owner's equity. So the formula for depreciation. So there are two methods. We've got straight line depreciation, which is it's the same every year. And this will be historical cost minus residual value over the life of the asset. So that means every year depreciation will be the same. So for example, if it's 2000 straight line, that means year 1, 2000, year 2, 2000, year 3, and so on. Reducing balance is when we reduce the value of the business, the asset in this case. We reduce the value of the asset in line with its usage rate. And that is given as a percentage, and that represents the amount of depreciation that will occur within the life. So, for example, 25, but to make sure it's reducing value, we go by carrying value. Now, carrying value or book value is the amount the asset is worth at a current point in time, and it's displayed on the balance sheet as such. You see you've got the asset name, and see here it goes less accumulated depreciation. That means that number there after deducting the accumulated depreciation, that is the carrying or book value. So it's not the historical cost, it is the carrying value. The historical cost is what we pay for it. So the idea is if it's 25% reducing balance, we go by the carrying value, it's going to be less because our carrying value goes down. And we'll do an example. I'll do a bit of a walkthrough of the math behind that in a bit. So, dealing with part year. Now, the one thing is the two forms are given there for a whole year, but if we have to deal with a part year, whether that is monthly or 6 monthly, you just times by n over 12, with n representing the amount of months the depreciation has occurred for. So if it's a monthly, it would be 1 over 12. If it's a 6 monthly report, 6 over 12. If we use it for 4 months, 4 over 12. So it's those little bits. If it's for the whole year, you don't need to do this because it'll be 12 over 12, which is 1. So let's start with our example. On July 1st, we purchased equipment worth $15,000 and we plan to keep it for 10 years and dispose of at the end of its life due to having a trading value of 0. Record the depreciation for the past year. So first thing we note is it is straight line. If it is reducing balance, they will say it is reducing balance. Normally they also say straight line as well. So how do we calculate this? Quite simply, going back to our formula of historical cost minus residual value over life of the asset, we can see 15,000 minus 0 divide by 10. We know the residual value is 0 because it's a trading value of 0. So 15,000 divided by 10 becomes 1,500. So how do we record that 1,500th depreciation? How do we record that expense? In the general journal, we go June 30 depreciation of equipment 1,500 and accumulated depreciation of equipment as a credit 1,500. And then you've got your memo, balance day adjustments, raw depreciation of equipment, memo 27. Now, I'm going to bring up the general ledgers here. So you can see depreciation of equipment, 1,500 as a debit, and the cross-reference accumulated depreciation of equipment. Ideally, you should be writing full, but as you can see, I'm a bit short on space. And in the accumulated depreciation of equipment, we see here it's a credit, June 30, depreciation of equipment, 1,500. Point to note right here, big point to note. It's that negative asset. So that accumulated depreciation is a negative asset because it reduces value from an asset. And the other one that you'll see like that will be in the bad debt and allowance for doubtful debts. Same process. You use that, you take that value off an asset. Now, where does this go on our reports? Now, obviously, depreciation of expense, because it's an expense, will be closed off to the P&L summary. Meanwhile, accumulated depreciation of equipment will be balanced because it's not an expense. It's an asset or negative asset. So we see here depreciation of expense. 12. We have a look. We can see depreciation of equipment, that expense, 1,500. We see that right there in the less other expenses category. And then in the balance sheet, we can see we've got the non-current asset. You've got equipment less accumulated depreciation, 1,500. So the book or carrying value would technically be 10,500. Now, depreciation, purchasing an asset. We've got, now I want to talk about buying an asset, just buying here. We're presented with the following document from Ovens. They purchase a commercial oven for $22,000. They pay an installation fee of $3,000, and then they pay a maintenance fee for the first year of operation only. The GST total is $2,600 because it's 10%, and the total amount that they have paid in cash is $28,600. So, when we purchase an asset, we have a few things we need to make. We need to account for, firstly, the cost of the asset, as you can see, $22,000. But we've also got stuff like installation fee and maintenance fees to deal with. And we need to figure out how we treat those, because we're going to be going back to inventory where we looked at product and period costing. So if we recap product costing, it can be equitably split and gets the inventory and asset in a condition to be used. So that's part of product. So gets a bit item in a condition ready to be used and can be equitably split. Most importantly, it's per product. Meanwhile, period, it cannot be equitably split. It must be its own expense. Normally, items that are time-based belong here. Now, if we look at both items, we can see installation fee installs the oven, getting in a condition to be ready, but it's just for that oven. Meanwhile, the maintenance fee also for the oven, but only for 1 year. So the product cost will be the installation fee. Meanwhile, the maintenance fee would be a period cost because it's only for 1 year, not the life of the asset. Whereas the installation fee, once it's installed, it's there forever. So our general journal would reflect that. So you can see the commercial oven here. That account is a debit of $25,000 because that's $22,000 on the actual oven plus the $3,000 for installation. Then you add on the prepaid maintenance fee for $1,000. That's a prepaid expense that will be deducted every month. And GST clearing $2,600 to cover the whole amount, and the bank $28,600. So everything on there on that receipt is there, or the EFT 3002. And that's purchase, commercial oven, and prepayment of maintenance fees. Whereas the installation fee, again, a product cost. So one thing I wanted to do just before we wrap up is look at or compare the reducing balance method with, you guessed it, the straight line method. So we're going to go back and we're going to look at, firstly, the reducing balance of the first example where they purchased equipment $15,000 that we plan to keep for 10 years and dispose of at the end of its life. So let's say 15%, and we plan to get rid of it. So eventually you will reach that same point. So let's just show how it's different. In year one, we would go 15,000 times 15%, which would give us 2,250. Now that 2,250 is deducted from 15,000 to give us 12,750. That 12,750 becomes the carrying value. That carrying value then is multiplied by 15% to give us a new expense of 1912.5. And we can see right there, it is going to be different year on year. And if you want to do a comparison, I think the best way to compare is there is a graph on screen now which demonstrates, hey, early on, reducing balance, the amount of depreciation is a lot more, but as the years go on, we can see that it becomes cheaper than straight line. You get to the same point, that same end point, it's just how do you allocate that expense? So I guess the question now becomes, when is it appropriate to use one or the other? And I think that appropriateness comes down to what your asset is. So something that that's going to be static, like a fixtures and fittings, you can straight line because it's always going to be there. You're not going to you're going to use it consistently the whole way through. But something like equipment or a vehicle that you might use a lot initially and use less as you go on, that can probably use reducing balance method. So if a business wants to have a higher profit, they might, or report higher profits, they may go straight line. But if they want higher profits later on, they might go reducing balance. Now, what reflects reality more? Either or. Again, it depends on the asset. So, just a reminder, the formula for straight line depreciation is historical cost minus the residual value over the life of the asset, while reducing balance is the depreciation rate multiplied by the carrying value. And that this will affect both the income statement and also the balance sheet, because you'll get different numbers associated with those. The only report that's never touched is the cash flow statement. So on that note, good luck with depreciation, and I will see you next video.